What's up, y'all? On today's episode of Behind the Earnings, we're going to be focusing on the banking sector. Well, that's Wells Fargo, Citigroup, Goldman Sachs, Morgan Stanley, and I forgot the last one. Just kidding, it is Bank of America. So, first off, a little sectoral overview. Auto and credit card delinquencies are up. So auto delinquencies have been increasing for lower income households, with loan balances rising to a record $1.66 trillion. Now, credit card delinquencies are up as well, reaching a total of $1.21 trillion. Now, this isn't great for the broader economy because a lot of people rely on those, especially lower income households and even middle class households. And then we have the Fed and their interest rates, what kind of path they're on. So right now we're in kind of a rate cutting environment, which is good for banks. They like that. We just had 3 rate cuts in a row, including a 25 basis point cut because of the softening labor market back in October. But in January this month, it's not likely that we're going to see a cut. That's just Jerome Powell's MO. Starting off strong with Bank of America. They beat both their earnings per share estimate and their revenue estimate, with earnings per share of 98 cents beating the forecasted 96 cents and revenue of $28.53 billion versus the expected $27.73 billion. So Q4 overall was stronger than anticipated. Their net margin ended up being 15.7% and return on equity 10.76%. Now with their dividend and valuation, they paid a quarterly dividend of 28 cents, annualized about $1.12 per share for a 2.1% yield and a 30.5% payout rate. So that essentially means out of all their net income, they paid out 30.5% of that back to shareholders. The banking sector has been taking a bit of a dive this week because of the current administration's call to cap credit card interest rate limits to about 10% instead of it being around 24.99% and up to even 36% for some borrowers. So that potential risk has been kind of deflating a lot of bank stocks this past week, and it could meaningfully hit credit card revenue and consumer credit availability. Next up, we got Wells Fargo, who actually missed their earnings, both in earnings per share and revenue. So they had a Q4 earnings per share of $1.62, below their estimate of $1.67. Stop, I'm not gonna do that. And they missed Q4 revenue. They had Q4 revenue of $21.3 billion versus the expected $21.6 billion. So they missed on both of those. Net income was $5.36 billion, which is greater than last year at $5.08 billion. CEO Charles Schwab had a couple of announcements for the company. He said in 2025, excess capital allowed for $18 billion in stock buybacks and an increase in dividend payout per share by 13%. So if you're a Wells Fargo shareholder, I'm sure you're pretty happy about that. And then there's going to be a removal of significant constraints by the Fed with asset cap provisions, which would enable Wells Fargo to grow their balance sheet much more rapidly in the future. They delivered a return on equity of 14.5% and set a target for 2028, a return on equity being between 17 and 18%. Now the stock did dive when they missed earnings. Of course, revenue and earnings per share, you never want to see those go down, but some of that pressure might also be because the overall banking sector is down. Next up is JPMorgan Chase. They beat both revenue and earnings per share estimates with an earnings per share of $5.23 over consensus estimates of $5 per share. They beat revenue, which was expected to be around $46.2 billion with a posted revenue of $46.77 billion. So they beat it by $500 million. That's a nice little margin right there. Now, profit fell 7% to $13.03 billion or $4.63 per share due to $2.2 billion holdover over its takeover of the Apple Card loan portfolio from Goldman Sachs. So essentially they took that over from Goldman Sachs. So you'll see that reflected later in Goldman Sachs' earnings. And that was a 60-cent per share hit, but they still beat when you adjust for that. Revenue rose about 7%. Now, the morning that JPMorgan issued their earnings, they were down about 3%. Again, some of those could be some of the other factors, but of course, earnings is one of the biggest factors. And Jamie Dimon labeled some potential hazards ahead for the company, including geopolitical conditions and a weakening labor market. We're kind of in a no hire, no fire status. So the whole market's kind of shaken up, and some of that's because of AI, some of that's because of just like deteriorating conditions, and obviously we're having the rate cuts because the Fed is trying to address the weakening labor market. But that was JP Morgan's guidance for the future. The Citigroup has really interesting earnings. They missed their revenue of expected 20.55 billion with an actual revenue of 19.9 billion. So obviously that's not the best, but then their earnings per share, they technically beat it. It was $1.19, but when you adjust for the Russian exit charge, it actually would have been about $1.81, which beats the expected $1.70. Now, so their growth targets. They want to continue to return excess capital to shareholders. In 2025, they sent $17.6 billion back to shareholders through dividends and stock buybacks, and they want to focus on returning to a tangible common equity target of about 10 to 11%. Now, as for the future, they aim to streamline their operations to reduce costs and completely divest from consumer businesses while also leveraging more AI adoption to make their company more efficient. Now, Morgan Stanley had a great day with their earnings today. They beat revenue estimates of $17.8 billion with posted revenue of $17.9 billion. This much, comparatively. And they beat their Q4 earnings per share estimate of $2.42 with a posted earnings per share of $2.68. Now, that earnings per share did fall a little bit from Q3, but it is up from Q4 of 2024. Now, they had a net interest income of $2.86 billion and a return on average tangible equity of 21.8%. So Goldman Sachs also had an interesting earnings day. They beat their Q4 earnings per share estimate of $11.52 with a posted $14.01 earnings per share, but they missed revenue. So the estimate was $13.79 billion, but they only posted $13.45 billion. Now, they're attributing their lower revenue due to their Apple Card business selling it to, JPMorgan, and they had to pay the early termination of that contract. So their return on equity was about 15.29%, but they do have a couple tailwinds to potentially help them out. Potential deal fees for Goldman Sachs because they're working on Bitpana's potential Frankfurt IPO. But the risk to the credit card sector does increase volatility because as all these banks are figuring out, they don't know what's going to happen with what the current administration is going to decide with that potential credit card 10% interest rate cap. So let me know below, what do you think about the banking sector's earnings season, and would you invest in any of these banks?